market vector indexes.
Not indices.
Why either indices or indexes? What makes it either one of those the right
This
one?
could be a whole outtake session, Ed.
No, this could be the intro, I think. But
Okay, fine.
just rolling into a conversation.
That's fine. The British official use is a plural of index is indices. The American official use is indexes. When I was at IFC World Bank and we introduced the IFC Investable Emerging Market, we had a big debate going. But of course, the World Bank has a language office because the World Bank operates under American English. And the jury ruled American usage indexes. I also happen to prefer it. But the irony is that S&P, which is a very American company, uses indices, and FTSE uses indexes. So go figure. But I am a true evangelist for indexes.
Go figure. Well, welcome to another episode of Trends with Benefits. This is a special quickie episode with our friend Stephen Schoenfeld. He is CEO of Market Vector Indexes, and we're going to be talking about global markets with a particular focus on Israel as well. And Stephen's a great person to have on the podcast to talk about the environment that we're experiencing now in early 2025. And, you know, as somebody, Stephen, that monitors, measures global markets, I don't know, high level, how would you summarize it? What's your take? What should investors be thinking about this volatility that we've entered?
So we are just past the first quarter, entering the second, but it feels like a year's worth of events have happened since late December. And markets have certainly reflected it, Ed. We ended 2024 with a kind of universal belief that America was ascendant. The economists had a cover with a roll of dollar bills taking off to the sky. And U.S. market cap as a percentage of global equity market cap was at a stratospheric high, even surpassing the weight of Japan in global market cap at its peak in '89. Now, the U.S. is a bigger economy, but 70% of global market cap is something really to behold. There was a lot of expectations that the new administration policies would be very good for business, very good for the markets. A lot was telegraphed, and a lot of investors were ignoring other key parts of the Trump administration platform, namely tariffs, which this administration decided to lead with in March. And we've had enormous dislocation in the last 6 weeks. In my opinion, it has reinforced what I felt was inevitable, that non-U.S. markets would start to outperform U.S. or at least add value to U.S. investors. But the impact of the tariffs has really accelerated that, in my opinion. And the relative performance of developed markets, especially developed Europe versus the U.S., but even emerging markets, has really highlighted that in the year-to-date and figures.
Yeah. And so, I mean, this is a reason to start looking abroad if you're a U.S. investor. It's been very easy to just be a U.S. investor and lean into what many people have as a home bias. Mm-hmm. I mean, do you foresee that these tariffs, or are there other risks that are out there that could affect U.S. markets that may just emboldens the case for looking internationally?
Absolutely, Ed. So it's been many years, in some ways more than a decade, since international or non-U.S. has outperformed. In those years, in those periods where it outperformed, it wasn't hard for investors or their advisors to make the case for international diversification. But as you noted, it has been hard. Any advisor who has overweight international hasn't been able to deliver performance. But certainly in the first 3-4 months of this year, you've seen it. But more importantly, you could just read the headlines and know that the dollar has also been weakening. So when the dollar weakens, foreign stocks get a tailwind. That has helped foreign stocks relative to the U.S. U.S. interest rates have stayed stubbornly high. And so foreign equity markets are still a huge valuation bargain relative to US. The US PE ratio, PB, is still high after such a strong correction in March and April. So the fundamental case is there, the relative performance case is there. US investors have had good reason to have home country bias because they've been rewarded for it. Also, compared to an investor in the Netherlands or in Singapore, whose home market is so small, you have to invest and not have a home country bias. US, it's kind of safe to do so, but I believe that era is over. I think we're much more back to the 80s and 90s where international diversification not only pays, but is essential for any US-based investor.
With the US, the two largest economies going at each other in terms of tariffs, would that risk other markets also, suffering a downturn as well? And would it just even out? Or would they slow down perhaps at a slower rate than the US or China might?
So on Liberation Day of April 2nd, you had the US fall the most, but almost all markets fell. If you're an investor in Vietnamese equities and you see the prospect of a 46% tariff on your export, and export is a very significant part of the Vietnamese economy, of course the market's going to react. But since then, many of the markets who had an initial sympathetic knee-jerk reaction along with the US have stabilized because they have other markets. The US is, of course, a hugely important export market, not just for China, but for Southeast Asia, for Latin America. But it's not the only one. And the European Union is making it clear that their market is still open. And I think many of the countries will adopt, and I think a case can be made that emerging markets as a whole, or at least emerging market ex-China, and China, we should talk about how it really is very different than the other emerging markets, can be a diversifier during this period. I'll use a few acronyms, but basically developed markets, and one of the popular benchmarks is EFA, has outperformed the US in a one-year period, certainly year to date, but so has emerging markets. And I think investors will continue to be rewarded. If the US market has some recovery, that's, in my opinion, a good opportunity to further diversify abroad.
Yeah. And I was going to ask you about that too, just kind of your quick take on emerging markets versus developed. You kind of addressed it. And perhaps the reason why I wanted to talk to you about that is, and one of the other reasons we have you on the podcast is to talk Israel. I mean, they were emerging market for a while, now developed. Mm-hmm. I don't know if you could talk a little bit about that, but how do you view Israel now? I think there's been some people liken it to a developed market with like emerging market characteristics.
So Israel did graduate in 2009, 2010 from emerging to develop. We could talk about the positive and negative ramifications of that. They weren't the first. Portugal in 1998 graduated from emerging to develop. Greece in 2001 graduated to develop and then was demoted first to emerging and then completely out because of its capital controls. I haven't kept count lately, but I think Argentina has been in and out of emerging markets at least 3 times because of the volatility of their policies. And something that affected both Van Eck and ourselves as an index provider significantly was in early 2024 when Russia was booted from the emerging market. Mm-hmm. There's a lot of dynamism in this category, but there's a lot of healthy debate over what is an emerging and a developed market. We at Market Vector consider Korea to be a developed market. So does FTSE, so does S&P, but MSCI still doesn't. We believe, and we'll be doing some research papers on this in the coming months, we believe that Vietnam is ready to be graduated and be considered a full emerging market. And perhaps not on the radar scope for most investors, we have launched an Iceland index, and there's now an Iceland ETF. And Iceland is considered frontier by some other index providers, but to us, it fully meets almost all the standards of a developed market. It's a member of NATO. It participates in trade agreements with developed markets. And so,
what makes it frontier? Is it size or something else? Or
yeah, frontier markets, for example, Qatar, which is one of the richest countries in the world per capita, was frontier until it was graduated to emerging. But on a per capita GDP, it's surely developed, but it has restrictions. So Iceland, it was more a matter of size. And secondarily, there are a few strategic industries in Iceland, notably fisheries. If you look on a map, you'll understand why, have restrictions on foreign investments. But those are changing. And so the market vector philosophy, which we could have a whole separate conversation on, leans more toward the economic status of a country, because we believe investors can find their ways in to markets. And for example, our Iceland index, in order to make it easier for investors, includes only companies that are easily accessible to foreign investors. And that's a pure play approach that I know VanEck has taken over the years with Vietnam and with other countries as well.
what I get out of your comments and thinking about that too is, do you agree that investors therefore need to manage exposure to different countries on a country by country basis rather than just broad groups?
My answer would be no, with a few asterisks. I think for most investors and most financial advisors and even large endowments and foundations, it's both way too complicated to do that. And that is something that they subcontract either to their active managers or to the benchmarks. That is why index provider decisions do matter. That's why China lobbied FTSE and MSCI to get the A shares into emerging markets. That's why there was just a Vietnamese delegation to visit FTSE for the same reason. But also within international, I think we will be moving to an area where investors themselves will have to take a little more responsibility. You could still allocate to developed markets and emerging. And if you're feeling bold, frontier, you could choose your benchmark provider depending on which methodology you like. But I believe increasingly the China decision will be separated out of emerging markets and become a dedicated choice, just like the US, not just because it's so big in emerging markets, but because even before the tariff issue and what we hope is not a full-blown trade war, but is increasingly looking like it, there are political and policy issues involved in investing in China that US-based investors need to consider.
But there would still be some place for slight overweights, perhaps, of using individual country exposure to a portfolio.
Absolutely.
Within reason. And then given the backdrop of your outlook for international markets or markets outside the US, do you have a few favorites? Some markets perhaps that are not well followed?
There's a few ways to look at it. Certainly, if you want to be a little contrarian, you could look in the emerging market universe, see which countries have dramatically underperformed over the last few years and consider an overweight. One good example of that would be Brazil. Brazil has not participated in most of the world market rally over the last 3 or 4 years. I would posit that most of the bad news is out in Brazil. They've been raising interest rates when the rest of the world was reducing them. So when they hit an inflection point, Brazil's a big enough country to have a slight overweight. Another example in the developed markets, and you mentioned it earlier, is a country like Israel. Israel used to be a medium-sized country in the emerging market universe. So it used to get a decent allocation from active managers. When it graduated in 2009 and 2010, it became a tiny little minnow in the ocean of developed markets. And so a lot of active managers don't get much exposure. But the real reason Israel should be interesting to developed market ex-US investors is IFA and the other developed market ex-US benchmarks. So IFA doesn't include Canada, so World ex-US does. You look at the developed world outside of the US and you have very little tech exposure. Now, I know after the last 6 months, nobody's rushing to add tech exposure, but if you look at a developed market allocation, it's really underweight in tech. And just putting some Israel in that developed market portfolio substantially increases the diversification within developed markets. And then, of course, there's a lot of other fundamental interesting reasons to consider Israel, including demographics, the fact that it's on a different economic cycle, and then last, but definitely not least, anyone who even vaguely looks at the news knows that there have been a series of crises in the Middle East. Those affect the prices of equities in Israel. Local Israeli institutions are the ones who generally take advantage of that when prices get quite low. But a case can be made based on valuations that Israeli equities are still quite undervalued, especially given the potential of the economy.
Can you talk a little bit about the technology makeup? Is it substantially a tech market, or give a broad brush of the sector makeup?
So I'm going to use the framework of the Blue Star Israel Global Index, nicknamed Biggie, and that index really reflects the entire Israeli economy. Why? Because it takes an approach that includes Israeli companies listed in Israel on the Tel Aviv exchange, but also Israeli companies listed in the US on NASDAQ NYSE, and even some listed in London and Singapore. By doing that, you get all of the traditional local economic factors, whether it's supermarkets, banks, retail, real estate, even industrials, but you also get a full exposure, complete exposure to Israeli tech leaders in cybersecurity, in AI, in big data, in internet software and hardware. And Israel, as many people are aware, after Silicon Valley, is the most vibrant tech ecosystem in the world. You just heard a month ago, Google made its largest ever acquisition of a company called Wiz, not to be confused with Wix, which is an index component of the Biggie Index, paying $33 billion for a company that's only a few years old. And the robustness of that tech ecosystem attracts foreign companies, whether for acquisitions or for R&D. More than 350 foreign multinationals have a presence in Israel's domestic economy, not because it's a huge domestic market, but because they want to be part of that tech ecosystem.
And you mentioned it earlier, where the institutions locally will invest in the market, even kind of given some of the crises that it has experienced and is going through currently. How do you look at those types of events if you're a U.S. investor? Do you shy away from those types of markets?
We have done research using the Biggie Index going back all the way to 2000. So we're talking 25 years of history of this index. And the pattern is incontrovertible. When Israel has crises, whether it's impacted by a global event or a local event, it is almost always, in retrospect, a good thing to buy when things feel worse. The big difference between what happened in October 7th of 2023 and previous crises is this affected local sentiment much, much more. And so the dip was sharper and foreign investors, rushed out. The Israeli institutions did buy in October, November, December of 2023. But the Israeli market, while it recovered, it still didn't fully recover until late in 2024. And its valuations are still quite a lot lower than comparative companies in developed international and US. And so my point would be is if you're a foreign investor and you're brave, you do rush in when the headlines look at the worst. But if, for whatever reason, if you or your advisor can't stomach that, it's still okay to wait a few months and then allocate because there's a slow recovery. The other thing that investors really need to remember, it's not just Israeli institutions. Israel has one of the strongest retirement system mandatory savings schemes in the world. And so it's literally called the Shekel Mountain. Every month, there's inflows into the Israeli market because of mandatory savings by Israelis. And plus you have, unlike most developed markets, you have a young and growing population.
Are there other factors that people should be aware of? Is there regulatory support for the market that would kind of buoy the market in times of crisis?
Well, I think the best way to describe the Israeli regulator, which is called the Israel Securities Exchange, is they have a dual mandate, very similar to the MAS, Monetary Authority of Singapore in Singapore. Their mandate is to maintain fair, efficient, clean markets, but they also have a mandate to develop the capital market. And people have seen how Singapore has developed their finance industry. The Israeli regulator, they do not intervene in the market. I know there are some countries in Asia who do organize national teams to come in and support the market. The Israeli government does not do that, but they are constantly looking to improve information flow. Israeli companies are allowed to issue annual reports in English. Investors don't have to look through a Hebrew annual report. Many Israeli companies are dual listed, so they trade in New York, NYSE or NASDAQ, and they meet the standards of US markets as well as Israeli markets. Israel has a robust ETF and derivative market. So all the hallmarks of developed market rules, regulations, and safety is there. In addition, Israel has a very conservative banking reserve ratio regime, very similar to Canada. And again, so that they really try to adhere to developed market standards.
Has Israel been affected by the U.S. tariffs?
Israel was given 17%, a little bit over the minimum. And that is despite Israel, many people don't know this, the first free trade agreement that the U.S. ever signed and became a model for all the others was in 1985 with Israel. So Israel does have a free trade agreement. The government in Israel is actively queuing up with other governments to negotiate with our Secretary of Treasury and the White House. So I'm pretty confident that will ameliorate. That's probably the high watermark. The important thing to remember about Israeli exports are almost 50% tech, software and services. And so that will not be affected nearly as much. And Israel, just like many other countries, is quite diversified. Maybe 15, 20 years ago, 90% of Israel's exports was US and Europe. But now it's much closer to a third US, a third Europe, and a third the rest of the world. So Israel's also quite substantially diversified into emerging markets. Israel has a very robust trade relationship with India, for example, that is growing in everything from agribusiness to defense.
How would you characterize the performance of Israel? If you're a U.S. investor, how does it complement your portfolio? Does it add a little bit of extra risk or volatility, but a little extra return? Or can it help stem the volatility of an overall portfolio?
So, one of the most overused cliches in investment is it depends. So it depends what your time horizon is. But if you look in the last 1 year, Israel has significantly outperformed both the US and IFA, so IFA developed markets. In the last year, Israel's up about 22%, whereas developed markets are up 8.5%. The US is up 5.7%. That's partly because that period includes some of the bottom. This year to date, the best performer in that same group of three would be developed international at about 6%. Israel is down 3%, but the US is down 10%. So you're still getting a positive benefit there. Part of why Israel underperforms IFA is in this shorter term period is exactly what I said earlier. Israel has greater exposure to tech stocks, and tech stocks have borne the brunt of the correction in the last few months.
Well, yeah, definitely. Thank you so much to talk about that. And we've spent a lot of time on Israel, which was my intention to talk to you about, just given the general resiliency of the market, and particularly in the neighborhood that it's in. So I find it a really interesting story for investors who might just overlook that. You mentioned some other countries today, Iceland, Brazil. Are there any other countries that you find interesting?
Yes, I'll double down on Brazil. Full disclosure, my wife is Brazilian, so I'm a little biased, but I have traveled there and I do see enormous potential in Brazil. They are very well positioned for a trade war because they have strong ties for exporting around the world. It's very unlikely that they'll lose their market in China or the US, but especially because they export a lot to Africa, to Southeast Asia, and to Europe. So from a trade perspective, they're in good shape. I would also want to add Vietnam. A lot of people immediately got bearish on Vietnam, because it got such a high tariff rate, and so much of their export is goods that used to be made in China, and a lot of the factories moved to Vietnam to avoid those tariffs. But Vietnam is a lot more than the exports that people visibly see. It's a very large country, well over 100 million population, a very young demographic. Most Vietnamese don't even know anything about the Vietnam War, which of course affects America's perception. And even though it's a communist government, the government is deeply committed to economic reform. I was lucky to attend an event in New York a week ago where the deputy prime minister was there with the deputy minister of finance and the head of the securities authority. They're deeply committed to opening up their capital market. And just as we talked about earlier, they're targeting getting Vietnam into the emerging market category. That's one of their policy goals.
You hadn't mentioned India. What do you think about India?
You are correct. I haven't mentioned it, but I'm spending a lot of time on it. We are very, very proud. We have one of the most well thought out indexes for Indian tech. We call it Digital India. We've just licensed that index to a Korean ETF issuer who wants exposure to India tech. India also is very well positioned for the tariffs. It's, first of all, it's such a large country, the largest in the world, that its exports just are not as impactful on their local economy. What their domestic economy does is much more relevant. But they also have very good relations with China, with the US, with Russia. They're too big to be ignored by any of the giants. They are, in my opinion, the most forward-thinking, most democratic, and most rational country within the so-called BRICS group. Mm-hmm. And they are non-aligned officially, but they have deep ties with the West, especially in security. Their tech ecosystem rivals developed markets. They have, along with Brazil, have digitalized the entire population's payment systems.
They've skipped over generations of development and use, right? And just gotten really advanced.
There was a little hiccup because they demonetized some large notes, but that got rid of a lot of gray market in the economy. And now every Indian has a digital passport, essentially, a digital social security number, and a payment system. So even the smallest chewing gum vendor in the middle of the median in the busiest street of Mumbai can accept electronic payments. And that is revolutionary. They also do have some tech giants, software giants, and they have excellent comparative advantage in that they graduate every year millions of very, very well-educated people in the sciences, math, technology, medicine. And so we as a business are very excited about India, and it's certainly an area that we're developing more indexes, and we hope to have more products tracking it. So thank you for reminding me.
Fantastic. Well, thank you so much for talking about that and the various countries and Israel as well. What's the best way for people to learn more about market vectors and what you guys are up to?
So our website is marketvector.com. I'm on LinkedIn and Twitter. I'm S.A. Schoenfeld. A number of my colleagues are very active on social media. We have a very cutting-edge research team on crypto and digital assets. We consider ourselves specialists in hard assets, commodities, individual countries, and of course, thematic tech. So we also offer a lot of research for free on our website. So we encourage you to come on, register, and get in a dialogue with us.
Fantastic. Stephen, thank you so much.
Ed, thank you for the opportunity.
And thank you for tuning in to another episode of Trends with Benefits.